The Financial Planner, presented by BSC, Investors Protection Firm.
Hello and welcome. You're watching Financial Planner. And over the next 30 minutes, we'll talk about various aspects of financial planning, specifically mutual funds and when you should be looking to sell, what you should do, when should you hold, and of course, so why shouldn't you get caught in the rut of panic selling? To talk more about that, we have with us Hemant Rustagi, CEO of Wiseinvest Advisors. Thanks, Hemant, for joining us this evening. Hemant, I think this is a very common phenomenon where we all sell when the markets are going down. I mean, it's just human tendency. You get nervous, you get paranoid, and you want to exit whatever you have, take that loss and stay put, or rather stay out. When should one investor consider selling a mutual fund? How does one decide in their head when is the right time to exit a fund? When is it underperforming? Whether or not it's underperforming because of the market conditions or just because it's an underperforming fund?
Well, it's a very important question that you asked me. I think for selling there has to be a reason. Like you must have a reason for investing. For example, when we talk about investing, there are various theories, various principles that we talked about in terms of investing. But yes, you're absolutely right. There are many times we see investors, making ad hoc selling decisions. I think broadly speaking, there are three occasions when one should be considering selling a fund. One is when an investor's investment plan changes or, ask him to basically sell. And why it will happen? You have a time horizon of, let's say, 10 years. Okay, when you complete that time horizon, you need to exit from that fund. So one reason is when you complete the time horizon for which you invested, you need to exit. The only difference is if it happens to be an investment in equity, and if you invested for a longer term, then I think the right way to exit from that is in a phased manner, which means that you should start exiting from a fund 6 months before that time period gets over. And the reason for that is that you need to protect all the gains that you made over the years. You don't want to be caught in a situation where it turns out to be a market timing, because if you wait till the last day and you exit, and if the markets are down at that point of time, you actually end up losing a part of the gains that you have made. If it happens to be a debt fund or a closed-ended fund, you can wait till the last moment, exit from there. So one reason is that if you have decided as per your time horizon, when you complete that period, you need to exit from that. The second reason, which is very, very significant and important, is when your fund is not performing. And this is where many investors make the mistake.
Yeah.
When they see a fund not performing for 3 months or 6 months, they're in a hurry to exit from there, which is not the right way. I think one has to give long enough time to the fund manager to perform. Broadly speaking, review your portfolio from that point of view once in a year, or maybe twice a year, or not more than that. So allow your fund to perform over a period of time. And it's very important to measure performance properly. How do you do that? How do you do that is every fund has a benchmark. For example, there are equity funds that may have a benchmark as BSC 100 index. Okay, if the fund has done better than the benchmark, then there is no reason. You need to look for consistent fund rather than looking at the top 5 or top 10. Because if you do that, every quarter those top 5 or top 10 will keep on changing. So you need to look and remain invested in a fund which is performing consistently. The second is to compare the performance with the peer group, now, which I feel is even more important as compared to the benchmark. Now, we talked about BSC 100 as a benchmark, for example, and suppose the average of the fund in that category, if the BSC 100 has gone up by 5% and the average return by funds in that category is 9%. So you need to make sure that your fund is performing in line with the peer group. So second reason why you should exit is performance, but allow the fund manager to perform, give it a reasonable time, and then decide. Third is that if the fund changes some of its, either investment philosophy, and it does not suit your requirement anymore. Now that can only happen if the fund decides to merge with another one. Okay, you see takeovers happening. You see two schemes merging. Okay, you see investment philosophy getting changed. For example, you may have a fund which is investing 60% in large cap and 40% in mid cap. If that asset allocation changes, that may not suit your requirements. So broadly, I think these are the three occasions where one should consider selling. In between, whatever happened in the market, I think the best thing is to just ignore that, continue with your process of investment, and keep your focus on the long-term goals.
Hemant, then why do you advise investors to not panic sell? How could that, of course, impact your long-term vision or plan that you have?
Well, it can. Like we discussed earlier, that everyone has to follow investment plan. So you have your time horizon. When you do panic selling, what you're doing is all that hard work that you did in the beginning, just throwing it out of the window, and going by the what is happening in the market during the short term. Now, we all know that the volatility exists in the marketplace, whether it's a debt market, whether it's an equity market. Investors need to understand that when you're investing in this, if you have to face volatility, continue your focus on your investment process. Because what happens is, typically if you talk about, let's say, equity market can surprise you both ways, even when the market goes up or when the market goes down. So, for example, if the market can go down quickly, it can go up also very quickly. The moment you do panic selling, what you're doing is you're changing your asset allocation dramatically. We have seen investors exiting from equities completely when they see market turning volatile. Now what happens? Suddenly you see the market taking a U-turn. And all your money is in debt. So you lose a great opportunity, because there was a study done in US over a period of 10 years, and what he said was that the majority of the market rallies happened on 1.3% of the market days, which means that if you're not invested in those days, right, you've lost majority of it. Right. So I think the key is that you keep your money invested and follow asset allocation process to make sure that you have taken the kind of risk you're capable of taking. And then it also gives you kind of diversification. I think this is one way you can avoid panic selling. And I think every investor should ensure that they do not make any selling decision in panic.
Hemant, I know we all love to buy low and sell high, but is that even possible for a common investor?
Well, I agree with you. I think all of us would love to do that. But believe me, as you mentioned earlier, even the best of fund managers find it difficult to do it. No, I don't think that is the right way. In fact, I would say for a common investor, the right strategy is to buy and hold. Keep your focus on what you want to achieve from your investment, and don't try to time the market. Absolutely.
Hemant, also I think one of the common factors that a lot of people are faced with is when you invest in a mutual fund, it's all about the fund manager's style of investing. I mean, at the end of the day, you're resting all your money in the hands of this one man who you have faith in, if I can call it that. What happens when a fund manager changes one job? I mean, they, like all of us, could probably change for a better opportunity.
Sure.
Do you go with him? Do you go along with him? Do you exit the fund that he's left and get into a fund that he's pretty much become a fund manager of? And if yes, how much time do you give before you make that decision of switching your investment to the investment that your fund manager is now moved to?
Well, it is a tricky situation, and we have seen that of late, a lot of fund managers moving. And it's a tricky situation. There is no straight answer to that. But I think the important thing here to understand is, as you mentioned about, we don't have, at least in India, the star fund managers per se. Most of the fund houses today, is very important for investors to know, follow a process whereby most of these fund houses, they have their in-house philosophy, investment philosophy. So there are broad parameters given to the fund manager within which he has to perform. The second is, most of the fund houses follow the process of an investment committee. Now, this investment committee has the CIO, the Chief Investment Officer, the fund manager, and the CEO as the members, which means that there's a collective decision making.
It's not one person.
Now, of course, as a fund manager, there will be some amount of freedom given to him.
But it's those parameters.
Absolutely. But this process ensures that the fund is never managed by a fund manager in his own personal or individualistic style. Now, what happens then? If this fund manager leaves, it is easier for a fund house to get another fund manager, either from outside or to promote one from the team that it already has. Now, if it happens to be someone who was already with the fund and now he's managing it fund, I think it's much more easier for him, because he's been the part of the process of the decision making. Even when the fund house gets a fund manager from outside, I think it's very important for investors to look at his track record. Today, there is so much transparency that any fund manager who manages your fund, his entire track record is available in the offer document. It's available on the website. So I think you can see what he has been doing in the past, how he has been performing. And if he has been performing well elsewhere, there is no reason that he will not be able to perform. So I think it's very important that, as I mentioned earlier, it's a bit tricky situation, but it's not a situation that demands that investors should immediately sell their holding and get out of the fund. I think even for a good fund portfolio to become bad, it takes around 6 months to 12 months. That much time you need to give it to the new fund manager and see how that particular fund is performing, and then take a decision.
And Hemant, also, most of us would like to invest in funds that are popular because they're obviously successful. But very often, the corpus of a successful fund becomes very large. Could that sort of impact the returns you get? Could that impact what you stand to gain if the corpus of the fund becomes very large, or rather if it gets too successful?
Well, you're absolutely right. I think many a times we see a fund becoming a victim of his own success. Well, it all depends, actually, again, on the kind of fund we are talking about. See, if it happens to be a fund which is, let's say, an index fund, or a pure large cap fund. I think we know that this large cap stocks are very, very liquid. I mean, whether the fund is of 1,000 crore or 10,000 crore, even 20,000 crore will not make much of a difference. But yes, for certain funds, it can make a difference. For example, if you're talking about a thematic fund or a sector fund or a mid-cap fund. Now, if you look at a mid-cap fund, for example, the key to success is stock picking, which means that, and we know that there are not many opportunities in the market, basically, when it comes to stock picking in the mid-cap segment. Now, to a certain size, a fund manager can differentiate his working from others and actually give you better return as compared to the peer group. But if this fund, unfortunately what happens is, whenever a fund is doing well, it gets noticed after it starts doing very, very well. That's the time you start getting a lot of money, which means there are two things will happen. One is, if the fund is doing very well, maybe the markets have moved up. Second is, the fund is doing very well. So when you get a lot of money in a mid-cap kind of fund, then he may have to then compromise on the quality, or he may end up doing exactly what others are doing, which means that he will lose the edge that he had over the competition. So I think whether the corpus will make a difference or not will depend on the kind of fund are we talking about. Similarly, if you look at a debt fund, for example, I don't see a reason why anyone should worry about the size of the fund. If let's say if it's a liquid fund and 30,000 crore, I don't see a reason. So I think fund size will have an impact, but one must ensure that he is talking about the right kind of fund, and not every fund will get impacted by the size of the fund.
Hemant, also increasingly we're hearing about fund houses that are looking to merge different schemes together. Why does that happen? First thing, if that happens, should that sort of impact your decision of staying invested in that fund that has been merged?
Well, this has been a recent phenomenon actually. Many fund houses have been merging their schemes basically. And I think the major objective there is to improve the performance of the fund. In fact, SEBI, the regulator, has also been asking the fund houses to merge the scheme to avoid overlapping and also improve the performance. In fact, another thing that SEBI has been doing and been telling mutual funds to do is also to change the name of some of the fund, which are a little misleading or confusing. So I think as far as the investors are concerned, I believe that it is good for the investors, because typically what happens is a smaller fund is merged with a larger fund. Okay, a non-performing fund is merged with a performing fund. So I think it is good for the investor. But yes, if as an investor you're not happy with what has happened, you have an option of exiting from the fund. Normally, whenever a merger happens, investors are given a 1-month exit window, which means that they can exit from the fund without paying any exit load. So if you as an investor are not comfortable with what is the changes that have been done, you can exit. But I generally feel that investors should stay invested. In most cases, I believe it is good. It's good for the investors.
Hemant, very lastly, early this year we had a takeover of a very well-performing fund. What happens when a situation like that arises? Assuming you're invested in a fund and it gets taken over, do you exit the fund because it's been taken over? Do you stay invested? If you stay invested, how long do you give the new fund before you actually make that decision of exiting?
Well, I don't think it's a great idea to exit as soon as takeover is announced. What we need to understand, what we have seen from the past experiences, the past examples in our country, is that investors have benefited. Typically, what happens is the fund goes into stronger hands. Now,
usually,
the example that you're talking about, maybe that the new fund was taken over does not have the track record. But let's face it, that, like I said earlier, for any good fund performance to get impacted, it takes time. So I think it makes sense for investors to give an opportunity to the new fund house to see who are the guys who are going to manage my money, what has been their track record before making a decision. So I think they need to give at least 6 months to 12 months to the new fund management to see how they're performing and then take a call.
Right, that's of course advice coming in on when you should look at selling a fund, when you should look at exiting your current investments, and whether or not too large a corpus for a fund could be a problem for you as an investor. With that, we'll take a quick break. We'll come back and take up all your queries on financial planning, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund. The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming from Dhruv Kamani, and he's 34 years. His monthly income is 1,10,000. And he's listed out his goals for us. He says he needs to pay 51 lakhs in 18 years for his child's MBA, 42 lakhs in 22 years for his child's marriage, 67 lakhs in 22 years for the MBA of his second child, 59 lakhs in 26 years for the child's marriage, and about 4.6 crores in 30 years for his retirement. So he's pretty much got his goals bang on. He also says he's got the following investments of 500 rupees in Reliance Gold Savings Fund, 1,000 in Reliance Regular Savings Fund Balance, rupees 1,000 Reliance Pharma, rupees 500 Reliance Banking, rupees 500 ICICI Pro Tax Plan, rupees 500 in Fidelity Tax Advantage, 500 in HDFC Top 200, 1,000 in HDFC Prudence, 1,000 in HDFC Equity, and so on and so forth. He says he also pays about 60,000 as premium for various ULIPs and endowment plans. He's got no other savings or assets. Will he be able to achieve his above goals?
Well, let me begin with the process that has been following. I would say that this is exactly the way how one should go about financial planning.
Setting their goals.
To setting goals, assign a time horizon and also set a target, which is what exactly is done. He's talked about basically 5 of his goals. He knows exactly how much time he has and what is the target that he needs to achieve. All his goals are for more than 18 years, which means that the focus had to be on an asset class where he can get higher return and also beat inflation. This is what exactly he's done. He's been investing through SIP in equity funds. So I think as far as the strategy is concerned, he's done perfectly all right. The problem is that he has far too many funds. Currently, his investments are 11,500, and he has 12 funds.
Yes, over
12 funds. Yeah, I think clearly a case of over diversification. The second is someone like him who's trying to build up a corpus for different goals over a longer period should be avoiding sector fund. There are 2 sector funds in the portfolio. So before we'll come back to the portfolio. Let's see how he's going to achieve his goals. There are 5 goals that he's talked about. The first goal is basically for his first child education, where the time horizon is 18 years, and he has a target of around 51 lakh. Now, assuming that he is investing, like I said, he can invest in good quality equity funds, and I'm assuming annualized return of around 12%. Basically, he needs to invest around 7,000 rupees per month to achieve his goal. The second goal is basically for the marriage of the first child, on which he has a time horizon of 22 years, and I think the target is around 42 lakhs, for which he needs to invest around 3,500 rupees. Okay. The third goal is basically for his second child's education, where the time horizon is 22 years and the goal is 67 lakh, for which he needs to invest around 6,000 rupees. And the fourth goal is basically for the marriage of the second child, for which the time horizon is 26 years, and I think the goal is for 59 lakh, for which he needs to invest around 3,000 rupees. And the fifth goal is his own retirement, for which he has a time horizon of 30 years, and he has a target of 4.6 crore, for which he needs to invest around 15,000 per month. So in all, he needs to invest roughly around 35,000 rupees. His current investment is 11,500, so there is a shortfall of 23,500. He needs to really rework, find out as to how he's going to be investing this money. I will now come back to his insurance portfolio. Okay, he doesn't have the adequate risk cover. I believe that his focus has been on endowment and ULIP. So I think he needs to seriously look at that, because he has dependents and he has certain goals. Okay, even if you follow the thumb rule, that he should go for a term plan, and the risk cover should be at least 10 times of his annual income. This is what I think he needs to do in terms of risk management. As far as existing portfolio is concerned, as I mentioned, one is he needs to reduce the number of funds. So my recommendation is that he should exit from those 2 sector funds. And there's another fund, SBI Blue Chip, which has not been doing very well. In place of these 3 funds, he can look at Reliance Equity Opportunity, which comes in the mid-cap category, but has been doing very well. I think that is the fund that he should look at. This is how he needs to rework on his portfolio, reduce the number of funds.
When you say reduce, how many should he reduce it to?
Well, there is no hard and fast rule.
But how much would you
But like I said, 12 funds for 11,500
it doesn't make sense. Yeah.
Maybe 6-7 funds. But it depends on if he is going to be investing 35,000.
Or stay with 11,500. Okay. On that note, we'll take a break. We'll come back and continue taking up your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund. The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. Hemant, we've got a query from Asad John Kerkata, who writes, and he says he's working for 11 months. He's a young chap, and he's got an income of 30,000 rupees a month. He spends 11,000 on loan repayment and 10,000 on miscellaneous expenses. He wishes to invest the 9,000 rupees to accumulate about 3 to 4 lakh rupees cash in 3 years. What do you advise him to do?
Well, I think the important thing here is that he has a time horizon of 3 years, which is not long enough to make his portfolio very, very aggressive. At best, if he's looking at earning healthy return, tax-efficient return, he can look at a combination of a debt-oriented hybrid fund and maybe some 20% in equity-oriented hybrid fund. Some of the funds that he can consider here is, one is Reliance MIP, and on the balance side, he can look at HDFC balance side. As a portfolio combination, if I assume annualized return of 10% over a period of 3 years, I think an investment of around 7,000 should get him a corpus of around 3 lakh or so. He does not have any emergency reserves also. I think this is the time he should start creating that before he start investing for the long term. Because he also mentioned, I think, that he wants to start investing for the long term.
Yeah.
So the remaining 2,000 that he has, because he has around 9,000 to invest every month, he should be looking at investing in short-term debt fund over the next 1 or 2 years. That will help him in creating an emergency reserve. And once he does that, thereafter he should start, his process for investing for the long-term goals.
Investment Ladder, presented by BSC, Investors Protection Fund.
With that, it's a wrap on Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.